Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. I am happy to say hello to my co-hosts here, Elliot Turner and Phil Ordway, as well as a very special guest we have on the pod today, David Barr, Chief Executive Officer, as well as Portfolio Manager at Pender Fund Capital Management, based in Vancouver, Canada. And I'm sure Dave is familiar to many of our listeners. He has been a great contributor to the value investing community and the MOI Global community. I've learned a ton from Dave, and so really look forward to this conversation. I think there's a ton we can all learn and get Dave's perspective on. So actually, I'll throw it over to Elliot to get us kicked off.
All right, great. So really excited to have you on, Dave. This has been really nice. We got to meet in person in Latticework about a year and a half ago. God, it feels like a lifetime ago. I wish, looking forward to the next time we could hang out and talk. I really enjoyed your presentation there where you spoke about, private equity style investing in public markets. And you were talking about the opportunity set, about how you have like this setup where there's some better valuations in public markets to kind of take that private mindset. But I was just wondering, a lot's happened since then, obviously. And how do you think about the environment today, where private seemed expensive before relative to public, but maybe the pendulum swung? So maybe we'll dive in with that and see where this goes.
Yeah, thanks, Elliot. And I'm looking forward to meeting again in person as well. It's been too long. The private world, it's changed quite dramatically in the 18 months since I gave that presentation. And public markets are great because when you take a common sense business approach to looking at companies, you can kind of figure out what they're worth on a private market basis. And Mr. Market does his things, and some days he lets you buy that company really cheap, other days it's pretty expensive. The setup we had seen for quite a while was we'd heard this narrative around, stay private longer, and there was a ton of growth capital financing a lot of these companies, and they're really, the narrative was don't be public. You got reporting requirements, shareholders aren't long-term thinking, and you got all the hassles with being public. And what we've seen in the past 12 months is a complete reversal in this, and the narrative around it has changed. And the valuations have changed too. And a lot of that, we kind of see in participation with retail investors in the market, the proliferation of SPACs in the market. So there's a ton of capital out there right now, and the later stage private investors are now saying, well, maybe we shouldn't stay private. Maybe we should take advantage of this valuation disconnect, where we can now get a way better valuation in the public markets and take our companies public. If you're in a later stage private portfolio right now, it's pretty opportunistic.
Yeah, and to bring it to one of your blog posts that I really loved, you wrote about the 80s Oilers versus Jacques Lemaire, right? Really hitting home with me on the hockey topic.
Well, as an Islanders fan, you must equally hate Jacques Lemaire.
I was going to say, you had to go with the Oilers, who kind of dethroned my Islanders, and then Jacques Lemaire, who kind of, I don't know, just put the kibosh on any offense my team could have for a decade. But, this idea of playing offense as your weapon versus defense and situational awareness, knowing when to switch from one to the other. So how do you think about that in light of, the environment's come quite far since July when you wrote that even. So how do you think about that today?
Yeah, it was funny. I remember in July, people were saying, why would you want to own small cap stocks? Because small caps have done so poor relative to large caps for so long. And now that we've seen, a rally in small caps, people are saying, why would I want to own small caps? when we're assessing the landscape, what we're looking at, primarily at company specific level. So we ask ourselves, what's the opportunity set like? Are the companies we look at, are they cheap on a private market value? Are they cheap on a discounted cash flow basis? Are they cheap on, a relative basis to what their peers are trading at? And that will tell us how aggressive we should be on an individual investment. And then you layer that into the entire landscape on how many of these opportunities you see that are high conviction. And when we see that, we are more aggressive, fully invested, letting Gretzky carry the day for us. The third level to it is then you look out there at the macro landscape, and I never want to be called a macro investor. But I mean, when I wrote that piece last summer, there was a lot less certainty around a vaccine. A lot of uncertainty on how certain industries were going to get through the shutdowns and whatnot. So when you kind of look at it from a probabilistic perspective, I think we were, last summer we were in this range where, you kind of had 68% of your potential outcomes were kind of normalized and things would be okay. But you had two very significant tail events. I mean, you had a big tail event that, vaccines aren't going to work and this virus mutated and really bad things could have happened globally. The other side is you had these very positive tail events where, maybe the world was going to be okay and, there was companies that were going to excel and catch massive tailwinds out of this. And, hindsight capital always nails these ones and says, well, the tail risk you really had to watch out for was, the offensive side and the positive outcomes. So that's kind of the third layer of what we're looking at. And I think we're still in a similar situation to where we were last summer, where, there's a pretty, there's a wide range of outcomes, but we still have a lot of tail risk, both positive and negative. So when we're looking at our portfolios, positioning on both sides of that coin, and this is way more art than science at this point. But being conscious of both sides of how they can impact your portfolios.
Yeah, no, those are a lot of interesting points. One of the things I think about right now and that I struggle with, maybe all of us could chime in a little bit too, is this idea that, I feel like right now where we stand, we have a much greater degree of comfort that the vaccine works, that things are going to go farther towards normal, with the biggest question being when exactly, normalcy resumes. But it's no longer this like big if question that's really far out in the future. It's like, within a year, we're probably going to get some degree of call it new normal going on again. But so obviously that means the economy goes from what was deep recession last year, Q2 in particular, to, we're going to put up some really gaudy GDP growth numbers. And so, in theory, we're early cycle, the beginnings of recovery, but equity markets are not there. So, equity markets are quite more mature in their cycle terms. So how do you like reconcile the two in that sense?
It's great question, Elliot. It's when we have situations like this, we really have to tie it back to the individual companies we're looking at and making sure, from a valuation perspective and a business risk perspective, we feel comfortable continuing to own it. I mean, we do have those tail events out there still, so we have to be aware of it. So from a portfolio perspective, just being a bit more cautious, being 5 to 10% of the portfolio in kind of shorter duration special fits type investments, where if volatility does rear its head quickly, we've got a bit of a buffer, but we've also got the opportunity to go in and buy things when they're on sale. But it's challenging to manage a portfolio with that kind of with the tail risk front and center in your analysis. And then, like when we kind of look at the evolutionists, I mean, a couple of things we've really focused on. I mean, my partner Felix, end of March, comes in. He's like, we have to get long tech. Demand has totally changed. Cash flows have been pulled forward. We've all kind of shared articles that talked about that in March, April, and Felix nailed that for us. But kind of when the second derivative, what's happening next, and that's where we're not invested yet, but we're looking at airlines, travel related stocks, because every time I have a Zoom call with a friend, one of the things we always talk about is where's the first place you're traveling when this is all over. And I think there is going to be a massive tailwind in consumer spending in very specific parts of the market or in industries where people get to be social again, because I love having this online call with you guys. I'd way rather do it in person.
Amen to that.
One thing I'm curious, Dave, this is Philip, by the way. One thing I'm curious about too is going back. I love the comments on your process, and I think I probably share a lot of similarities in that process. But as you're looking around, whether it's today in a somewhat unique situation or more generally, and you're looking at the whole business and looking at valuing the whole business, and you mentioned comparing it to peers and looking at it outright. Do you also take the view as if you owned it outright, and then how do you come up with any sort of numbers, whether it's a point estimate or a range? Are you using kind of an absolute hurdle rate, an opportunity cost driven approach? How do you go about doing it?
Yeah, good question. So I think we're all probably fairly aligned with this. We're looking at absolute returns, so we have an absolute hurdle rate. And yeah, when we look at the business, it's very much what do we think this business is worth on block, and that really drives our analysis. And because when periods like March happen, and we had a great conversation on our weekly investment team meeting yesterday, and I asked everybody, what company in our portfolio that you follow right now, if it was down 50% next month, would you be mad at yourself that we hadn't trimmed? And I was asking the question, kind of inverting, trying to figure out which names everybody had the highest conviction in or lowest conviction in. I find that just that level of conviction really ties into understanding the business and what it's worth to a buyer. I think when we're looking at, we're in the public markets, so Mr. Market's always having his fun and games with us. That's why we also overlay it with, where are the peers trading, and what do we think a financial buyer would pay for it, and those types of things, because there's more than one way to make money in the stock market. So if you can kind of layer in 2 or 3 ways where the company you're looking at is undervalued, it increases your probability of that business going up.
Yeah, absolutely.
Dave, I'm curious if you could expand a little bit on this notion of positive tail risk. I understand downside tail risk, but what do you mean by positive?
Well, the majority of returns in the stock market are from a very small group of companies, and to actually capture the returns, you have to be invested. And there's a lot of times you never know when these positive returns are going to come in the market. You kind of look at the micro cap, small cap market. Q4 was massive, and if you'd sat out Q4, you basically missed out on a lot of the advantage of being invested in the small cap sector over the past 3 years, because the returns were all in Q4. And I think I was listening to your podcast last week. I think you guys were talking about Bill Brewster's tweet about it's not timing in the market, it's time in the market. And I think that really, that actually captures the positive tail risk, because you kind of, when there's a lot of uncertainty out there in the market, the probability of a positive tail event and having these big rallies, there's a higher probability of it. On the flip side, there's also a higher probability of negative tail risks, and having the volatility on the downside. And I think in this market environment, because I think there's a heightened probability of both positive and negative tail risks, it makes managing portfolios super interesting.
Yeah, that's a really interesting point about the heightened probability of positive and negative tail risk, which I guess explains why the VIX is kind of persistently high, even though markets are kind of going up and up since the end of the summer. But then, thinking about some of these specific like hotel travel related recovery plays, it's like I want to get constructive on them too. Then I'll type up something like Hilton and see that the stock's, making all-time highs. And, it's hard to, I feel your enthusiasm. I'm like, yeah, I can't wait to travel. We're all thinking about our lists. I remember in the summer on the Pinterest earnings call, they're like, actually the travel vertical is getting a lot of action because there's so many people starting kind of the top of funnel exploration of where they want to go, what they want to do. But like, so are you thinking about, you said airlines, but are you thinking about airlines and hotels? Or are you also like going one step beyond that, like what people are going to need to kind of fulfill their missions on travel?
Yeah, and we kind of we dig into the weeds a bit. So I mean, I think the like airlines and hotel stocks are generally kind of large cap, and we're looking a bit more into the weeds, and it'd be more smaller airlines if we were in that space. But trying to the tough part is like the obvious stuff always moves first, and we'd like to have a couple more data points that things are going the way we think they are before we deploy. And an example of that would be in the spring when we saw kind of Google and a bunch of the large tech companies rally pretty quickly, and we focused more our time and energy into kind of the Stitchfixes and Zillows, and Felix calls it the zips, but that's second tier where you kind of got the data on how business or consumer behaviors changed, but you're able to kind of get into that laggard company, so you can kind of get a bit more of the joyride.
Yeah, very interesting. You guys really nailed the Stitchfixes and Zillows of the world. How do you think about those now? I mean, how quick are you to turn something over and try to find the next one? Or I'm sure at the time you're like, yeah, I'm underwriting to something that I want to own for the next 5 years, but then suddenly you get 5 years of return that fast. How do you process that?
Yeah, that's a great question. You must have been listening in on like our investment team meetings for the past. I mean, this is such an interesting topic because it resonates. We identify as value investors, which sometimes you don't want to say that because people automatically assume you're deep value. And we were able to buy these companies at very attractive prices in March and April. But now, obviously, some of these things are up 5, 6, 7, 8 times, and our process around selling, trimming, and this ties into 100 Baggers, which is just a great book, and with Thomas Phelps, and then Chris Mayer updated it. But when you got the business fundamentals working for you, and the company is still growing its intrinsic value, and whatever that proxy may be, EPS, cash flow, EBITDA, whatever, however you're monitoring the business. You don't want, you want to hold on. And so when business quality is high, which it is in the case of these companies, and valuation, is still, it's high, but, then we take a second look at it. And I mean, it's funny, I was teasing Felix about becoming more of a venture capitalist because, what we're looking now is, when you look at a Zillow or a Stitch Fix, I mean, could these companies be 4x in size 10 years from now? And the answer is yes, they could be. And so, that gives us kind of a 15% IRR over the next decade, which there's obviously a heightened level of risk associated with that. But, given the execution and the optionality and the positive business fundamentals and the positive feedback loops which occur when businesses are doing well, we're quite happy to hold these things. I obviously do trim them. They're nowhere near the weight they were, but they are in the portfolio. But if we, when the company's growing and we have that a vision that it could be, because the market is so big and management's done a great job executing in the past. We're quite happy to hold, but we're talking about a lot more art than science right now. That's for sure.
So Stitchfix is an interesting one. I looked at that last year too and was so brilliant that I passed on it. But one thing that jumped out to me was I don't think I ever got past, the 50th percentile in my knowledge or understanding of it. But one thing that did jump out was there was a pretty high short interest for a while there. Did you evaluate that? Did you talk to people who were short it? I think it's probably, this gets to a different, pet peeve of mine, is that I think it's probably okay to declare victory in that debate now, but maybe not. But anyway, I just wonder how much you take that into consideration, particularly now that, we have some hindsight to help us evaluate what anyone who was short 6 or 12 months ago was thinking, and how the facts have evolved to disprove or support that thesis, and how much that impacts your thinking as you're buying something, holding something, adding, trimming, all that good stuff.
Yeah, Zillow was a similar situation where there's a lot of public shorts on that as well. And I think what's interesting is when there's a large short interest, but you've also got like an equally loud bull crowd on it. I mean, these stocks become battleground stocks, and battleground stocks are incredibly volatile. There's really good reasons why the business might not be worth what people think it is, but there's a lot of alternative arguments where it could be worth a lot more. And I think when we were looking at the short thesis on a lot of on some of these names, what we saw was people were taking more of a fundamental value investor type approach, and that's great. At the end of the day, a business is the future value of its cash flows. But have technology companies changed that discussion a little bit? And I think yes, some of them have. But it doesn't mean they can't be incredibly polarizing. I mean, we love going back and looking at Amazon and Netflix, and those were some incredibly high profile shorts on those stocks and large short interest at various points of time. And I think you could definitely do victory laps on your Amazon and Netflix longs now. But having these battleground stocks and these large short interests, I mean, you do need to have your eyes open, because a lot of these short investors are smarter than I am, that's for sure, and they do deep dive on these companies, and so they do uncover a lot of very insightful information. But if sometimes you can have a different time frame horizon, or a different understanding of a business where the way other people might be looking at it may not apply now. But it's actually that short interest which actually creates the more compelling opportunity.
Interesting. So suffice it to say, you're more than happy to take the other side if you just disagree on the merits of the argument. Then is that fair?
Absolutely, and but eyes wide open.
Sorry, one other thing that jumped out from your comments that I thought was really interesting was you said, obviously, the value of the business is the present value of its future cash flows, which I hope we could all agree on, even in this day and age, even though that does seem to be somewhat lost in the ether. But you said technology companies have changed the discussion or the framework a bit there. I don't want to put words in your mouth, so I was curious if you could expand on that, because it's a fascinating topic for me.
Yeah, I mean, when we look at companies kind of over the last 50 years, I mean, I take an HVAC company, and it's an HVAC company. One starts up in Pittsburgh, one starts up in Seattle, and the best company starts to dominate that market, and then they slowly expand out across the U.S. and grab market share, and you can build 20 great HVAC companies, 50 great HVAC companies. The economics around delivering technology online is a lot different, and so it creates much more winner take all dynamics. So, if you're not kind of in the top three, you're probably a little bit too late to the party. There's obviously exceptions to every rule here. So the economics are quite different. What that drives is it actually drives a much heavier reinvestment rate. And one of the everybody kind of in our MOI global communities, follows Constellation and Mark Leonard, and probably the most insightful, or one of the, I've got many insightful observations, but the average life of a vertical software contract, I mean, once companies install software, they're going to keep using that for about 18 years or even longer. People rarely switch off these. And so what that actually did is it changed, it changed the predictability of the revenue stream of technology companies, because and a lot of us, when you look at hardware companies where it's more product based, and you don't have that stickiness and predictability of revenue. And the second aspect of it is the margin profile. And when you build a great technology company, you can start, particularly in the software space, you can be driving 30 to 50% incremental free cash flow margins. The challenge is that incremental free cash flow, rightfully so, is generally heavily reinvested in the business, so that it, basically you're seeing net income zero. And so how do you actually back out the cash flow on that? And there's some people that will just say they haven't proven they can make a profit, so I'm not going to do any work on it. There's other people that will take really aggressive estimates and say every software company is the same and can drive 50% free cash flow margins. The truth generally somewhere in the middle. And I think that's where a lot of the really exciting opportunities in technology and software are today. It's trying to figure out the difference on what that end margin is.
So suffice it to say then, we would agree, or if you don't, let me know, but we would agree then that a good company that's utilizing a software model or is a broadly defined technology company that's winning and having a lot of success is just occasionally worth a lot more than we're used to assuming based on historical shortcuts that are proxies for the valuation process. Is that well said, or would you disagree?
I totally agree.
Okay. So, I mean, the one thing then that I'm curious about to follow up, it sounds like you probably know more individual business models and examples than I might, but how many wolves in sheep's clothing do you think are out there then? Because I'm with you. Everybody loves to point to the examples of Amazon and Netflix that had relatively unimpressive GAAP earnings for a long, long time. They also happen to be led by once in a generation genius CEOs that had unbelievable skills across a whole range of areas, right? Everything from operating the business to, deploying capital and hiring people and leading individuals and dealing with regulatory issues and just everything you could want on a wish list for a great CEO. So, and then I just look around today and because they were so successful, and it's not just them, there's, a good list of them, but like you said, it's a relatively barbell world out there where these winners on one end are so extreme that they get all the attention, but then, by definition, the other end of that barbell's a lot of losers. And I just see a lot of companies today that are kind of masquerading under that guise of, oh yeah, don't worry about it. We're losing a lot of money right now, but trust me, like the 10 and 20 year payoff is going to be really super awesome. And again, if you believe that the only possible way for a business to be worth anything is to eventually have some sort of value that manifests itself in cash, that math just gets really, really difficult. I mean, I guess more simply said, there are just not going to be that many Amazon and Netflix style successes out there, right?
Well, it's too bad there isn't, because it would make our jobs a lot easier, right?
For sure, yeah.
I mean, that is just a great question, Phil. And yeah, there's a lot of companies you need to filter through. And I think what's challenging is we've had Bezos writes such great shareholder letters, and Mark Leonard write great letters. And so there's this blueprint that's, a more promotional CEO can say, well, I know how to talk to these investors and use the right metrics and hit all the right tones so that we can keep this party going. So it's, there's a lot of wolves out there, and they know exactly how to present the information, which then makes it incredibly challenging from us as analysts trying to decipher it and figure out, what is that true free cash flow generating ability at the end of the day. And that's where there's no shortcuts on that. It's trying to figure it out to the best of your ability. And if you get it right more often than you get it wrong, the return should be okay.
Yeah, I'd love to take a cut at that one too, because I think, that's something that I've been thinking about a lot lately. And where's the line drawn between some of these companies that can actually kind of cross the bridge and generate really lush profitability versus those that are going to run into problems. And I kind of break it down into two kinds of companies that'll run into problems in this sense. One is the kind of company who claims they have, and I'm talking about on the problem side of the bucket, the kind of companies who claim that they have a really large TAM, but don't acknowledge that at some point their TAM converges with 1, 2, or 3 other competitors. And yet they're building like an operating infrastructure as if they're going to capture a really meaningful portion of that, when it's just not going to be possible. So, it's going to be really hard for that company to get it right on when to scale down and actually make money. The other is one that has terrible unit economics from the start, right? There's a difference between having good and bad unit economics in being unprofitable. And I've encountered this, I've kind of recently spoken about my involvement in Naked Wines. And the UK investor base is pretty much diametrically opposed to the US investor base in terms of appreciating the Amazon and Netflix model of zero GAAP profitability. Like they just don't like it there. But US investors do like it. And, you can break down a company like this and be like, oh yeah, so on a customer level and on a per shipment level, the unit economics are positive. But then you contrast it with something like Fubo TV, where it's like they're actually losing money on a gross basis on each and every subscriber. So, you say, what happens if they, 5X their subscribers? They're not actually going to be making more money. They're going to lose 5X as much money. And so, I think that's where you draw the line. Now, there are some companies who with scale, their unit economics improve. And there's an argument with the Fubos of the world, which is they have 2 levers to pull. One is they're going to have more leverage over their suppliers, right? They're really wholesale transfer pricing of content. They're buying the content and selling it to customers. So if they have more customers, they have more leverage so they could improve their margins. And 2 is they could add on ancillary offerings. And it's like, okay, maybe you believe that, but that's not the kind of risk. I draw my line at taking that kind of risk. I want to make sure I understand the unit economics and I'm betting on those to scale in contrast of growing into some degree of profitability on a unit basis.
Great point, Elliot. I mean, understanding unit economics is the key to investing in any of these. You might be able to make money investing in companies with negative net unit economics. I'm not going to try. I'll leave that to somebody else. Another aspect you kind of hinted at a bit there was also was pricing power and the ability to actually increase prices over time. And I remember, like the same Latticework I gave my presentation, Sean from Ensemble gave the Netflix presentation talking about the latent or the pricing power Netflix would have, and kind of does a survey in the room. If Netflix charged $2 more, would anybody cancel? And nobody put up their hand. And that's actually one of the areas I have a harder time understanding. I can focus a bit more on the cost side in the unit economics and the margin profile. Having that pricing power is a wonderful thing, and it's the other side of the coin there too.
Yeah, I've been working on a company right now where I'm really struggling because the pricing power is so damn good and unappreciated. I was talking to one of their customers and he's like, yeah, I've been paying $300 forever. And I was like, okay, well, so, when was the last time they raised prices? And he goes to look and he's like, actually, I've been paying $500 for the last 3 years. And it's like, wow, if the person didn't even know that the price was up 80% over the last, 3 years, that's some real pricing power, and they could go pretty far. But like, no analyst is really writing in pricing uplift. And the company, I think for good reason, doesn't talk about flexing their muscle on that front yet. But it's a real hard one to wrap my head around. Like, how do you underwrite to it? How do you think about that? Netflix is a great example. I think Sean Standard Stockton was like pretty early in saying, like, what's the true price of Netflix and what does the margin look like? But how do you gain conviction around working behind that? That's one of the harder ones for me.
Me too. That's why I still kick myself. I didn't buy Netflix twice.
Right. And then I guess one kind of like broader question, and this is something I was in a debate with a group last night on a Zoom where we like kind of bi-weekly talk about like what's going on in markets and how we're thinking. And the question is like, how much of what we're talking about right now, what we think we've really learned in recent times, is a function of where we are in the cycle and what has been reinforced by today's cycle that won't necessarily be true going forward. And there was a great blog post out today about how like Bruce Berkowitz was the all-star of the last cycle and he's not this cycle because he didn't really have anything other than a recipe that was very regime dependent. So like, how do you think about that? Situational awareness is one of the concepts we started with. So how do you think about, a situational awareness that might indicate maybe the regime's changing and we should be thinking about some things a little differently? I'm really grappling with that.
Yeah, I'd like to hear about this too, because it's something I've been thinking about a lot, and maybe Dave will have a better answer because I don't. I mean, I was just starting to read that Bruce Berkowitz article myself, and people made the same allegations against Bill Miller, even though he's proven to be quite adaptable. And certainly, all the great investors are going to have to pivot their tactics every 5, 10, 15 years or so. And it does occur to me that there's a whole generation of people that have gotten exceptional results pursuing one very narrow playbook for the last several years now. And that just, it can last longer than we all think it will, but it certainly can't last forever. So it just seems like there's a lot of hidden landmines out there in that regard.
Yeah. And beginning and endpoint sensitivity create the appearance of winners and losers on a year-to-year basis. And I'm such a contrarian. We're sitting here, and Compound Town is celebrating the end of value investing right now. All right, and people are when everyone starts talking about it's different this time and new business models and whatnot, and which I was just doing, and I'm fully aware of my mental gymnastics here. But when we get periods of time like this where one style and subset is really dominating, and you look at all these people posting their portfolios and what their great returns have been over the last 3 years, and the portfolios all resonate with one another and look alike. It's how the regime changes. Gosh, your guys' guess is as good as mine. But we are at this one point in time where this one style is working incredibly well. I think if you kind of extrapolate it back, though, the returns in the market are always driven over the long term by the economics of the business, and there's a few businesses which really drive the returns of the market over the long term. And you kind of look at some of those businesses that have been doing it. They're not in nosebleed territory in valuation by any stretch of the imagination. And there's other people out there that will say a lot of these things are still screaming buys. So, is there a reversal on this style imminent? Maybe, but I think there's still, over the long term, you're not going to be too disappointed as long as you kind of pulling it back to Elliot's point. If you get the unit economics right, and Phil, to your point, if the free cash flow generation does, it is there and continues to increase, you're gonna do okay.
Right.
You might not have the experience you had in the last 3 years, but you're gonna do okay.
Bill, I do love that you mentioned Bill Miller there, because one of the interesting things when you look at his portfolio, it's like not balls to the wall tech, right? I mean, he's got some things that are a little bit everywhere. And I do think that's something that there's something to be said about how that's helped him kind of perform and succeed across
sure.
multiple regimes.
Yeah, because he's never stopped learning, right? He's never actively, I mean, I don't know him personally, but he's never shut off his mind and said, oh, I just got filthy rich buying tech companies at 20 times sales and selling them at 40 times sales, and that's all I'm going to do for the rest of my life, right? I mean, he's very actively and intentionally curious and trying to learn. So even though he made some horrendous mistakes, as he would admit, leading up into the financial crisis, where for 10 years, right? I mean, he had done nothing, well, not nothing, but he had done a lot of buying levered financial companies, and he was buying Countrywide the whole way down. And, he learned from that mistake and he moved on and got better from it. And that's what everybody has to do. And I'm here to make an unprovable forecast that there are all sorts of people who are going to be feeling a whole lot like Bill Miller at some point in the next few years. And whether or not they pivot and learn from it and get better in the future is going to be the key test.
Yeah, right. That's an interesting question. I mean, Bill Miller is the kind of guy, he's on the board of, or was on the board of the Santa Fe Institute.
Right.
I got to meet him through that once, and he's like the person who sits in the front and is just like eagerly taking notes and learning everything. And to be able to do that at his age, right? That takes a unique personality and a unique drive.
Right. And I don't think most people have, not only do most people not have that drive, but most people can't wrap their brain around the notion that I was just dramatically right. And that's the most vulnerable point. And that I need to tear down everything I just learned and move on, right? I mean, it's like learning how to play, golf with one swing that gets you to a certain level. And then you have to stop and completely learn an entirely new swing if you really want to take it to the next level and keep getting better and keep winning. And most people just can't do that. It's really hard.
Totally. There's so many biases at play there where when you're right, you internalize it because you're smart and you deserve it. And when you're wrong, it's bad luck. And so it is really hard to keep on changing a winning game, right? It's it takes that lifelong passion for learning to really drive that. But it also takes the humility to you need to recognize that luck got you there, and it's not going to carry you through for the next cycle necessarily.
One thing, Dave, that I struggle with a little bit, and it kind of dovetails also with something Elliot spoke about some time ago, which is those overlapping TAMs where different companies put up these huge TAMs, justifies their valuations, the investment in the business, and so forth. Something that I think is kind of similar to that is just if you take all the valuations in the market right now for companies that are going to be disruptors, but then also for the tech giants, and you add what's happening in the venture space, to me, all those valuations just do not compute. Now, you can make, individual cases very strong why company XYZ is going to do it extremely well. But when you aggregate it all up, I have a hard time believing that, Apple, Google, Facebook, and those Microsoft, the giants, can keep delivering reasonable growth when you got the venture space so active, funding maybe not companies that are going to go head to head against these giants with moats, but that are going to nibble at the edges. And I feel like people don't really aggregate things up. And given your experience both in the venture space as well as in public markets, I'm wondering kind of how do you think about all the money going into the venture space and the fact that venture capitalists are much more than they used to be in the past? I mean, I think the Andreessen Horowitz model of having best practice operational support for these startups has really won out. And so it's not just a founder who has to figure out a ton of things. They get like real teams behind them on pretty much on day one that know how to execute on marketing, on the sales and so forth. And then with the valuations of companies in the public markets, I mean, someone's going to have to be disappointed, right?
Well, absolutely, and that's the beauty of the market, because there's different contingencies thinking the world is going to evolve in different ways. Venture capitalists are buying into new companies who say they can either create a new market or build a better mousetrap, and that can, in the earlier stages, that can justify evaluation, and then over time reality can set in and they might be proven right or proven wrong. And then there's obviously the competitive dynamics at play, and where there's the competition kicks in, TAMs start to overlap, and then they get second order effects on how does that impact the valuation of the incumbent, how does it impact the valuation of the startup. I think one of the underappreciated aspects of what the technology world has done is it's creating new markets. And I mean, a position Felix built earlier this year was in Square, and reading the book about the founding of Square and the innovation stack it really talked about how the payment processors didn't want to deal with the individual glassblower who was working at the local artisan market. And those individual artisans were basically shut out of the modern payment system because the payment providers, they made it way too hard for them to enter it, and as a result, they could only accept cash in these markets, and they lost out on a ton of revenue. But the demand was there, it just wasn't accessible. And so when Square came in and made a POS accessible for the individual glassblower, it created a whole new market that currently wasn't there. And it's interesting, taking it to the next level with Square today, with their Cash App and their focus on cryptocurrency. I mean, there's in the U.S. right now, there's 12% of the U.S. population's unbanked, I think it is. And imagine not having a bank account in a world of COVID where you need to tap your credit card to pay, and you're shut out of society. So what's interesting is their Square is with their Cash App, and it's having the ability to bring this 12% of the unbanked population, which is an underprivileged part of the population. It allows them to bring them into the mainstream, and could be a wonderful outcome for equality right around the world. It's seeing, having these new TAMs, which they're invisible TAMs that people don't know about today, which because technology makes things more accessible, actually opens up these markets. So I think if we would have had this conversation 15 years ago, and we would have said, here's what the valuation of these companies are going to be, we would have probably had the exact same discussion where it's like, well, that's greater than the entire TAM. And now we're probably saying that, well, there's still a lot of room to grow in the TAM, but there's all these other factors at play now. So I think people underestimate how the TAM grows over time.
Yeah, payments is a great example, and I think you make a really good point. When I started with PayPal, Dan Schulman had just become CEO. They were still in the belly of eBay, about to get their own wings. And he's like, I see our competitor as cash, right? At the end of the day, we're competing with cash. We're not competing with anything else. We're trying to digitize payments, and we want to get that going. And then the second layer to his story was that the entire financial system is wrought with very high fees, especially for underbanked populations. And if you could find those areas where fees are exceptionally high and you could use the scale and the fixed cost structure of technology to drive those costs down, you can make a way more inclusive financial system that gives access to way more people. So you grow the TAM in that way. And I find that to be really compelling and interesting. Have invested behind that in PayPal, which I still own, and Square, which I don't still own, unfortunately, regrettably. But then, like, okay, Roku, similar situations with the TAM appearing to be much bigger. But then you have the problem of what Phil talked about before, the wolf in sheep's clothing, where there are these companies who, I think they know what they're doing. I don't want to single out the one company who I think has done it most egregiously just yet. But maybe one of these days I'll single them out. But, like, there's some companies out there that knowingly put out a TAM that there's no way they could, they should probably distinguish with like a SAM, like a serviceable addressable market, not like some sort of pie in the sky, like we'll never capture this. And, really what they're trying to do is get people to disanchor from the actual underlying performance of the business and pencil out 5 years. If they capture, X percent, it's worth, Y dollars, and get you to be lazy as an analyst. And I definitely think that's one of our challenges, right? I think that's one of the hardest things to do in our shoes, especially as these companies are growing quite swiftly, where we don't exactly know what duration of growth to underwrite to. Where, do they pull forward 3 years of growth, or do they pull forward a decade of growth? And how do they comp this year going into next year? Like, all these things are very much top of mind right now.
That's like another hour-long podcast right there, Elliot.
Yeah. I can kind of keep going with that. It's really, like it's quite an interesting, challenging juncture, but that's always what makes it fun, right? That's what gives us a job too, to think about these things. But then I guess one of the things that we've almost ignored on the other side is, have there been some sectors where valuations have gotten so compressed, where the expectation of change is so great toward the direction of technology, but there's still something underlying strong? Like, do you look at some of those areas as well these days?
I mean, we're always trying to find them. Nothing really comes to mind right away. But I did want to follow up on your point on, how much demand did we just pull forward? And I think one thing that's really interesting to look at is kind of JD and Alibaba in China in coming out of 2003 with SARS there, because they had a similar shutdown with SARS in 2003 to what we saw globally last year, sorry. And there's some really interesting data about how consumer behavior had changed, and the proliferation of online shopping and B2B software. So there's some really good data points out there already when you kind of look back at what happened in China in the mid 2000s. And I recognize that it was a different setup, because here we are already in an internet-enabled world in North America and Europe. But there are some lessons we can learn from that period of time, which I think can help clarify our thinking on how the cash flows have been pulled forward in some of these industries, in the companies we traditionally follow here in North America.
Yeah, I was going to say, I really like the comment, and I totally agree. I mean, depending on which side of the debate, if there is such a debate, I mean, I think it's easy for people to get sucked into a us versus them, like techno-optimist, techno-utopian versus like the grumpy old man shouting at the wind, get off my lawn kind of thing. And that's obviously ridiculous and oversimplified. But I do think one thing that gets lost is that if technology is truly useful and truly good, it's not a zero-sum game. And so technology was everything from a plow to, a supercomputer, right? There's technology everywhere, and it doesn't have to be, I mean, we often associate it in this day and age with something very specific, but that's not necessarily true. And so I do totally agree that, the total market size of any sort of business and the economy writ large, I mean, that's what we rely on to drive productivity and economic growth, is that expansion over time. And yeah, it's just the tricky part, and the thing that I struggle with sometimes is just separating those winners and losers. And I think the probability distribution of those winners and losers is important and often lost in the shuffle. So do you have any, I don't know, Dave, do you think explicitly, like, do you draw out scenarios? Do you do a probability analysis when you're looking at a business, or is it a little more simplified? Like, this is a good business with good unit economics, good management. We feel qualitatively comfortable that it's going to be bigger and more successful 5 years from now.
We do both. So we do our quantitative analysis, which is we run 4 scenarios, our bull, bear, and base case, and then a disaster scenario. And kind of, a lot of times our base case will be what is private market value of the company, and we'll have a high probability weighting associated with that. But then understanding what the bull case may be, as well as the bear, and assign probabilities. And then on our qualitative overlay, exactly to your point, it's what is our most predictive qualitative metric we have is quality of the business. And I mean, we just simply go high, medium, low. And when our data over 5 years is whenever we invest in high quality businesses, it adds alpha to our portfolios. Again, we're totally going back to the endpoint sensitivity of quality growth companies have done really well recently. But that's one factor we will overlay it with, as well as inside ownership, founders. When you look at our portfolio with Square and Zillow and Stitchfix, like all founder-led companies, so really mission-driven companies where a founder just really cares about the customer experience, but knows how to do it in a way that makes money. You could probably put Elliot on a Twitter rant right now. Cue the music on that one.
Always ready.
We're shareholders too, Elliot. So I love it when you go on your Twitter rants. I totally agree.
Yep, my co-investors, right?
Exactly. So there's a lot of qualitative aspects we look at: business quality, founders. Murray Stahl kind of coined them predictive attributes, things which are qualitative in nature, but quantitatively increase your probability of a good outcome in the business.
Yeah, a lot of those attributes are quite interesting. I mean, you've seen a lot of companies have tremendous success with that today, and across regimes, right? So that's definitely a pretty good truth to look at, even across like industries. One thing I wish we'd get away from is having to call a lot of these companies technology. Oh. Like, Stitch Fix is selling clothes. They're deploying technology to do it better, but like at the end of the day, I think, when I was approaching it early on, Stitch Fix is a whiff on my part, and I got too wrapped up in like thinking of LTV and, what they look like more as a subscription company. And, a friend was like, why don't you think of them a little more like you would like why would you approach Nordstrom without doing an LTV and try to like build a DCF and thinking about like what they could do as a business? And I do think there's definitely this convergence of worlds where you look at like a company like Walmart, they're actually doing pretty well in the tech side, or even Target, right? They're doing really well in e-com. So in tech world, they're like doing all right. And if you were to strip out just their performance in e-com, it would look pretty impressive, but not many people are willing to think or underwrite them in that way. Maybe it's really just, it would do investing a favor if we got away with the tech moniker, and maybe some of the halo goes away from some companies, but kind of level the playing field. How do you approach that problem?
You want me to go on a rant, don't you? It's challenging. I mean, there's been points in time where we're 60% technology in our portfolio, and people get freaked out, like, holy smokes, you have so much technology risk. And to your point, we don't actually look at it that way. We, where your exposures are and what companies are, really it's what their product is and who are their customers. Who are they selling to and what do they do? And Stitch Fix is a great example. I mean, they sell clothes, and they've figured out a really novel way of doing it in an efficient way and in a way that customers really like. I mean, it improves the customer's experience dramatically. And so you're right. I mean, you do have to benchmark them against a Nordstrom's or another clothing retailer. And people look at kind of, in Amazon, and is it a tech company? It's like, well, no, they're an online marketplace that delivers stuff to your door basically day of, which is fantastic. But I mean, Costco's doing pretty much the same thing. Walmart, Target, all these other companies are, they're all kind of fighting in the same TAM. And in the early innings of tech adoption and proliferation, they were very distinct markets. But convergence is coming, and what we've seen in the last year is it's accelerating. And it was really interesting watching the traditional retailers in March and April last year. You could see the ones that dramatically struggled to shift to an online model, and capture the growth opportunities that present themselves. And there were other companies that just took off like bandits because they were well positioned. And I mean, so I think from kind of as being a business analyst geek and just loving this stuff, it was so fun getting these data points where we were always speculating, which of these companies is doing a good job with their online platform. And Target wasn't on my radar list, but what a great job they did. And now, to your point, Ellie, you peel back the onion there. They've got a great little business there that's growing nicely.
Right. Yeah. And I guess one of the keys is that they had the assets in place even before everything closed and the world changed, right? So there was a degree of foresight involved in it. They just couldn't find a way to steer their customers to that channel or acquire new customers in that channel versus some of the others. And, I think that's one of the things I think about a lot with COVID when we get to these conversations about like, are things stretched? Are they not? Like, will there be a kind of resumption of past normalcies after this all? It's like everything's, we've kind of thrown a wrench into the entire system, and you get to start certain things from a first principles approach and think about optimizing for where they should have been had we not been encumbered by our past. And that has consequences. Like there's no going back on a lot of these things. And the rubber band's stretched really far. And it makes sense that things are moving really far, really fast. And it makes sense that volatility is like a little elevated because like you said very early on, David, and I really liked that point about how, like both tails have a much higher probability right now.
For better or worse.
For better or worse.
Yeah, it's the other really interesting data point that comes out of these periods of time, and right, like we've got this heightened volatility, and it's because it's uncertainty and there's so much turmoil going on. But we always try and figure out, back to the kind of the founder CEOs. I mean, not every company has a founder CEO, but who are the forward-thinking, mission-driven CEOs? And when they're able to pivot quickly like that, it demonstrates that they've actually were very forward-thinking in dealing with the competitive landscape. So they were ready for this, but now the market's actually there for them. So this is great because it gave us a lot of data points on management teams and how they look at building their companies. And you can't, business models are being disrupted at a higher rate than we've ever seen. So if you've got a management team that's just sitting there milking the cash cow all day long, sooner or later the short sellers are going to show up at the door, and then you're going to be having an ugly conversation with yourself. So it's been really illuminating for us on who the management teams are we want to support long term. And there were some great conference calls where we to have a conference call or be on the company's quarterly conference call, and it'd be like because of the timing of financials. They're talking end of March for the year end, and then they give guidance for Q1, and they reiterate guidance on March 15th, and then a couple months later or a couple weeks later they're They're like, oh yeah, sorry, we missed guidance. It's like, well, how disconnected from your business are you when you can't, like, you're 2 weeks in and you're missing stuff? Like, there's a CEO that really is spending way too much time, on the beach or watching YouTube videos, and not enough time talking to customers and talking to people that work at the company. So it was great. Twofold. We got our list of CEOs we probably want to support. We got a list of CEOs that are now with our Don't Touch with a 10-foot pole list.
I have a feeling Elliot and I might even be talking about the same company on that list. I'm going to ask him offline. I don't want to call anyone out publicly either. We'll stop from doing that. And we certainly are not in the business of making specific investment recommendations. But Dave, I'll put you on the spot and see if you want to call out any industry, company, executive, management teams more broadly that you think really do it the right way. I mean, you've mentioned a few companies that you're obviously optimistic about, but again, don't feel compelled. I would probably punt on this if you turned around and asked me. So please don't feel obligated. But I do think it's interesting, given the work that you've done. If you it's not going to be able to be proven right or wrong for maybe 5 or 10 years, right? If you want to be so bold as to say that this company is going to pull a Netflix or an Amazon, like, that's not a disprovable thing anytime soon. So I guess you have a little bit of air cover that way.
Yeah. So, I mean, I love waffling on questions like this. I think there's a lot of people out there, and you can look at Bezos and Mark Leonard at Constellation's done a great job. So there's a lot of those exemplars out there, and hindsight capital is telling us we should own their stocks a long time ago. We're spending our time trying to identify who that next generation is. So there's still a substantial level of risk. So I'm not sure if I feel totally comfortable.
No, I don't blame you. I would have struggled to answer that too. I just wanted to see if you had something that we hadn't already touched on that you wanted to call out for the future. It's not, frankly, it's almost more disturbing when people make bold pronouncements like, oh yeah, I've definitely identified the next Jeff Bezos. His name is X. I'm like, all right, really? No, okay.
Yeah. Well, it actually does that CEO or entrepreneur a disservice as well, because everybody does things their own way or differently. And they the best CEOs are the ones that learn a little bit from a whole bunch of different people and incorporate that into their own best practice. And I think that's akin to how great investors are formed too. It's they have their own process, and it's learnings from multiple other investors they talked to, or they've read about, or they followed, or whatever the case may be. So we're all going to do it a little bit different.
Maybe just one thing from me before we wrap it up, Dave. This notion that we are investors and not just business analysts. So it's great to be looking for these businesses all day long, and obviously that's the absolute core of good investing over the long term. But at the same time, there's a lot of things happening in the world that could be, kind of like a tsunami coming at our nicely built sandcastles here that we're talking about. I mean, how do you think about just the world in general as a portfolio manager, rather than just a business analyst? I'll just throw out kind of this notion that we could see higher interest rates at some point, and what it might mean for businesses where a lot of the cash flows are, deferred pretty far into the future.
Yeah, I mean, there's always tsunamis on the horizon, and if you kind of, the risk is that there is a tsunami that wipes you out. So when we're feeling good about ourselves, our tendency is to make sure that we're being cautious about catastrophic risk, because I think that's when you can really get exposed with whether it's weaker business models or balance sheet risk. So I think whenever we're kind of looking from an investment perspective, looking at what's going on in the world today, tying that back to the companies we're invested in, in periods of time like this, it's, probably better to be a little bit, have Jacques Lemaire at the helm. But so it's just making sure you're not getting wiped out if something bad does happen. But, that being said, I mean, if there's always bumps in the road, and, we've got, hundreds of years of financial data where stock markets go up, and, companies are going to come up with novel ways of creating solutions and servicing customers. And I mean, I can't, what a massive stress test so many companies just went through last year, and to come out the other side as growing successful companies really, really demonstrates the robustness of capitalism and companies as a whole. So it's there's a great opportunity out there, to look at the companies now, which I think are, I'm not going to say anti-fragile, but, kind of know how to pivot in these challenging times.
Well said. Anyone have any other thoughts? Phil, Elliot, anything else for Dave? Or Dave, any concluding thoughts?
That was great.
This was a lot of fun. Thank you for joining us, David.
Appreciate it.
Yeah, thank you guys, and I really enjoyed your conversation on note taking a couple weeks back, and John, please let me know how your ongoing quest with Rome goes, and maybe have like a MOI focused group on how we can optimize Rome, because we're always looking at taking better notes and tying it all in.
Thanks for that prompt, Dave. I'd love to figure it out myself. I see people on Twitter kind of tweeting about some amazing things they're doing in Rome, and I'm just trying to figure out how to do, the two-way linking. So once I make some progress there, I'll be happy to share.
I'm totally being selfish. I've learned so much from John, from you and the MOI community over the years, John. So I'm looking for another thing I can learn here, which I'm getting ready to dive into. So thank you.
Well, thank you so much for joining us, Dave. This was a great pleasure. Thanks, Phil and Elliot, for making it a great discussion. And thank you all for listening. Looking forward to next week. Until then, take care, everybody.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.